So today, let's talk about the opportunity cost of Alibaba. I think increasingly, there are more and more people backholding Alibaba saying that, oh, how good would it be if I can exit at X price target or X amount? Or, oh, look at all the potential amount of profits that I could have made if I bought X or Y company instead. So rather than me trying to educate you guys as if I'm any smarter trying to navigate this black box of a stock market, I'll probably just try to share some of my thoughts regarding this entire idea of opportunity cost. Sometimes, us as humans might be a little too smart for our own good. We always like to think that we are the special one. Somehow or another, we think that we are smarter than the general population or the general populace. And we might just be the next chosen one, to be the next Buffett or to be the next Peter Lynch. Time and time again though, data has proven that even professional money managers or professional fund managers, where their entire career is built on their ability to deliver results in the stock market, most of them probably can't even beat the major indexes, but retail investors on the other hand just feels like we are blessed with a superior methodology that we saw on YouTube or even on Reddit. I think we can all agree on the ultimate objective of investing in the first place, and that is to make money or to essentially fight inflation. Nobody wakes up one day and hope that they lose money in the stock market. If you do, I will provide you with my bank account. You can feel free to send those money to me. But you must wake up every day wanting to smash the like button on my videos because that will make you feel special, at least in my heart. So the only difference between you and me is really just our different circumstances. We are of different age, we have different background, we have different upbringing, we have different tolerance to risk and volatility. And ultimately, we have different financial objectives. So the funny thing is, if our objective of making money is the same, why are we not using the tried and tested approach? Just save as much money as you can, avoid lifestyle inflation, and just dump all your money into a broad-based ETF like the S&P 500 and just DCA until you retire. So I can't guarantee that you'll be rich from this method, depending on how you define rich, but you'll probably be able to accumulate a decent amount of nest egg required for your retirement. So essentially, the data stretched all the way until post-World War II. That's almost 100 years. You pick a 20-year time period during the last century, investors would rarely lose money investing in the S&P 500, assuming they held through all the way. The spectacular thing is, if you were to ask our parents, relatives, or even some of our more matured friends who invest, you will hear a ton of sob stories on how much they got burned by the stock market, on how the investments went south, even when the underlying investment instrument is an ETF like the S&P 500. So the big question is, how? To put it nicely, because of unforeseen circumstances. You might need the money urgently, you might have misjudged the company, misjudged the management, misjudged the stock market. The list of reasons go on. On top of that, we are easily manipulated by our own emotions. Like I alluded from the start, sometimes we are just too smart for our own good. On the flip side, we are extremely good at self-consolation though. Very good at it. When we are at the right side of the bet, it's probably because we have the foresight and the credit is all ours. When we are on the wrong side, the market is clearly missing out something and misunderstanding the company. I'll be the first to admit, by the way, I'm quite sure my own self-comforting mechanism and self-hypnotizing ability kicks in from time to time. So the biggest culprit of most of our downfall will probably be attributable to our own emotions. Like they said, in investing, you don't need to have a high intelligence or high IQ. You just need to have the right temperament. So even if we are doing considerably well, when we see our friends doing better than us, we get jealous and we start trying to chase for their returns. If I do 20% and I see people doing 40%, we'll start trying to take on additional risks to help chase the returns. If we are not doing so well, we might get severely affected, especially when we see the rest of the entire market doing well, when you are in a bear market or a broader bull market. And we always search for the next opportunity to exit and for an even better opportunity to deploy our cash to chase the returns that we need, just because we have something to prove. And it is exactly because of this constant comparison, the idea of an opportunity cost is born. It's as if your mind is constantly re-evaluating the decision that you have made maybe a day ago, a week ago, or even a month ago. Was it a good buy? Is there better investment opportunities out there? Can I deploy this for a higher rate of return? And most importantly, what am I losing out on? I think after some time, it perpetuates into a negative reinforcement cycle, and it will drain the life out of you. I think at least in the realm of investing, there really is a factor of affinity. What's meant to be yours will come to you. Sometimes the timing of the investment might just not be suitable for your time horizon, and you might have just missed out on the opportunity of your lifetime. But if you were to really sit down and think long and hard enough, how many better opportunities are out there on a day-to-day basis? And how many are really once in a lifetime? I really don't know. Of course, I'm not saying to just sit on your ass and get complacent and essentially wait for God to send you your next investment idea via Amazon Prime or even via Taobao. You have to keep up and constantly be in search of new knowledge to expand your own circle of competence and to essentially create more headspace and more surface area to meet new investment opportunities. Funny enough, at least on this channel, I primarily express my views on Alibaba and maybe their competitors. That's it. People who connect with me on a more personal level knows that I'm interested in a wide array and a wide range of companies and probably have a lot more opinions than I should have. Problem is, I don't air them haphazardly on this platform because I have nothing much to value add. I prefer to keep my trap shut unless someone initiated that conversation in the first place and wishes to find out my opinion. So the biggest existential question you can ask any investors out there would be, there are tens of thousands of stock in the market. Why do you only invest in XYZ company? Because clearly there are many more with better risk reward. This is essentially a question without an answer. The only thing you can get out from this question is just the feel-good factor for the one posing the question, because he or she probably stumped you with it. In future, if you are greeted with this question, just reply with, "I'll send the question back your way, my friend." Better risk reward? From whose perspective? Yours or mine? How do you know what my assumptions or views are on this particular quote-unquote risk you are talking about? What rewards are we exactly describing here? How do you even normalize the risk reward of every single investment instrument out there on a standard scale? You don't even know anything about the investor, and it just speaks volume when you ask this kind of question. Personally, not an advice or tip in any way, never try to go against your inherent human nature. In essence, just do what you're comfortable with. If you really can't sleep well at night when you have investments in China, then don't invest in China. Don't try to convince yourself that, hey, this is a once in a lifetime opportunity and the government is essentially like God giving me the opportunity, etc. And no matter how cheap it is, it's not worth sleepless night. Another issue is we always get enticed to the shiny and the sexy stocks. Not saying that they're inherently bad or anything, but because of this distraction, there will probably be a very costly price tag to it in the long term. If people are comfortable with an 8 to 10% return on an annualized basis, buying the S&P 500 in the long run will do. If people wish to outperform the market, they will start trying to get into active investing and start trying to pick winners out of the lot and to outperform the market. I'm sure most of such active investors have their own internal required rate of return. I'm not talking about a yearly review on the overall portfolio strategy, but more like micro changes based on sentiments or how the market reacts on a day-to-day basis, which would probably do more harm than good. I think all in all, opportunity cost is a myth because you clearly cannot turn back time. And although you might not have invested in Alibaba in the first place, who knew what you would have done with that same pile of money and what was your then thought process? That pile of money could have been invested into another company that lost even more money throughout the same period, or worse still, get fished away by scammers and the entire ROI is negative 100%. Bottom line, never try to go against your natural human instinct and do things that is not suited to your own personality or your own investment temperament. I fundamentally believe that most people should just buy a broad-based ETF like S&P 500. But then again, even though the S&P 500 have performed relatively well as an asset class for the last 100 years, who can guarantee the continued 8 to 10% return in the coming 100 years? Life is never a bed of roses. And don't be blindsided by some of the assumptions you are making subconsciously. Some are even speculating on the changing world order. Who really is to say that the American empire or even the American stock market is poised to continue flourishing for the next 50 to 100 years? Nobody exactly knows. So everything is done in hindsight, and you can only connect the dots looking backwards. So ultimately, just do whatever you're comfortable with, and I'll see you in the next video. But more importantly, I'll see you on the moon. Goodbye!